Thanks for joining us. This is Notepad. I'm your host, Ibrahim Sani. As we continue on what to expect for 2023, the questions on recessions, cost of living, inflation, and many more seems to be the kind of things that are on the lips of us investors as well as on the institutions that are going to invest our cash in for this year. Because of this, I have the pleasure to have Patrick Chang, the CIO, or the Chief Investment Officer of Equities of ASEAN at Principal Southeast Asia. Patrick, thanks for taking the time to come over to the show to discuss a few items when it comes to investing in 2023. I want to ask you a few things here. Number one, do you fear 2023? Is it going to be something of a scary year for us all investors, or do you think that the global growth is actually returning and the recession, while we talk about it all the time, is generally quite well mitigated to allow for many of these growth opportunities to go on for this year?
Thanks for the question, Ibrahim. So let's cut to the chase, right? I don't believe that you can't make money in a recessionary environment, right?
Okay.
So that's point number one. Why do I say this? Very, very simple. Because I think at some point this year, or already happening now, the markets are already starting to price in a very soft landing. That's our base case. What is soft landing in normal language? It really means that it's going to be a very mild recession in developed markets. Now hold that thought. Developed markets are comprised of US, Japan, and Europe and UK, right? In the US itself, we do believe that the soft landing that we're talking about will happen in the third quarter. A lot of the monetary tightening that we saw late last year and much part of last year is going to impact growth in the third or fourth quarter of this year. That's why people all talk about recession. The problem I have is a lot of investors, including ourselves within my team, are also worried about it because they think that this is going to be a global financial crisis. That is not our base case. Our base case is that we are starting to see a silver lining in markets, a silver lining in economic recovery. Why do I say this? Very simple. China just reopened, right? The biggest worry I have today is the influx of tourism that's coming to Malaysia and the rest of Southeast Asia, right? But jokes aside, this is real. The reopening is going to reignite the recovery of the second largest economy in Asia and also in globally. So I think when you put that together with the kind of expectations that I think about of less recession fears, markets will start to recover, and it's already happening. Year to date, look at the head share, up 9%, Hong Kong listed shares, right? Because on the back of the reopening. Taiwan, Korea reported very bad numbers. You saw that in semicons and all that stuff. Still up as well. Malaysia obviously is a bit of a laggard, but I think at some point Malaysia, we can talk about later, is going to be also what they call a comeback kid, you know.
Okay, we can talk about the Malaysia comeback kit very shortly, but when we talk about the reopening of the economy of China, everybody is excited because, well, consumers are now in the billions, going to now enter markets, including Malaysia. But generally speaking, the COVID-19 fears are real. We're looking at potentially new variants entering new spaces, including that of Malaysia. Is that a risk worth talking about?
Yeah, absolutely, right? So think about it, where we were before about a year and a half ago, right? Whether it's Malaysia, US, or Europe. We had mass vaccinations, we had the booster jabs, and we eventually we got basically what we call immunity, herd immunity, right? I do believe in the first quarter of this year, when everybody goes back to Chinese New Year, the number of cases are rising. It's already rising. The latest anecdote we got is Shanghai has got 75% of its population, 23 million, already infected by COVID, right? But the thing is, the reality is, we all know at the end of the day, we need to live with COVID. So I think China is starting to read it because whether we like it or not, China is a very pragmatic economy. They don't go out there and say, you know what, I'm going to reopen my economy and let all the people, pass on, right? Ultimately, at the end of the day, they've done some science and analysis to it. So that's basically the thesis. Now, I think the data that you're going to see in the first quarter is going to be weak because of this. Consumption might be weak, but that's priced in. The government, as we speak, have been rolling out lots of measures, whether it's through the property market, whether it's through vaccination booster jabs, whether it's going to be basically getting people out there and expanding. Because the reality is, think about this world, right? The Chinese government will not allow the economy to sink below the 4% mark because the reality is they're not used to it. Of course, they want a more sustainable growth, but ultimately, sustainable means a 4 to 5% growth. Most analysts or economists out there are expecting about 4.8% growth, back on the back of reopening. My guess is to be somewhere between 4.8 to 5% or 6%, let's say, depending on how the reopening adjusts itself, right? So to answer your question, in a not so long-winded way, essentially our view is that I think the China reopening with COVID is going to be something that we have to live with, but I think people are going to live on, move on.
Okay, and of course, another element here is that the recession is impacting the US and China markets actually quite critical right now. Is that going to be a problem, as so to speak, making money from this recession?
Well, in every recessions, you can either choose to buy equities or to buy fixed income, right? So my advice
fixed income is down across the board last year.
Yeah, absolutely, right? And that's because yields went up, right? I mean, we have 50-year highs in yields, right? You know, in my lifetime, and you know, I've never seen yields as high as it is today, right?
Yeah.
So when I speak to my dad, you know, if he watches this, he'll tell me, you know, why are yields so low for the last decade? Now yields are back to where they are, and everybody's complaining because asset prices have to adjust to higher yields.
Yeah.
Right. So the point being that I think, to answer your question, if you believe there is going to be recession, there is going to be an opportunity for fixed income. Because the Fed at some point cannot raise rates forever. It's going to choke the economy, right? Now, if you are a more growth-oriented, you want to take a bit more risk, my advice to customers out there is buy equities. It's cheap, especially in Asia. Our thesis in a global equity portfolio, if you have one, is to focus on Asia, not because I'm an Asian specialist, but because reality is the reopening is going to make sure that China rebounds, and it has rebounded. In case you guys don't realize, the head share market has rebounded 40% from the low since October, end of October. The next question you're going to ask me, is this sustainable? Absolutely, because valuation is supporting it. It's 10 times PE, cheapest market I know in the whole world. So I think if you put that in the context of growth and income, and that's where we are advising our customers to think about that, then you have a more balanced portfolio, you know, and that's how we want to advise our customers.
On top of market diversification that you speak of, I also want to learn more about some sectors that you're interested in. You touched a little bit on the semicon sector, but you know, very recently, I mean, locally, Inari has taken a hit, considering that Broadcom is no longer going to supply chips to Apple. We're also looking at some other sectors in this country that might see some risk moving forward towards this year. Are there any sectors that is of interest to you, and some sectors that you don't want to touch with a 10-foot pole?
Okay. To answer your question on the semicon sector, I think what we are looking at in the semicon sector are what we call rear view mirror data, which means that a lot of these supply chains, which are beneficiaries to the companies that you talk about in Penang, and also to associated EMS companies in Johor, for example, all of these guys were impacted because of China. But now that China has started to reopen, the order books will come in. As we speak, you look at it, Samsung basically, I'm not supposed to talk about stocks, but I can give you an example. Samsung reported one of the worst numbers ever. Stock went up 5% on they reported numbers. It tells you that the markets are forward-looking. They're looking for a third to fourth quarter rebound in order books and so forth. So I'm a big believer that technology, despite what has happened, has a lot of value. And we're very selective in that front, obviously. Now, what I would invest in, when you talk about in Asia itself, let's talk about Asia. I would invest in, obviously, Hong Kong, China. I would invest in Korea and Taiwan. Basically, I would invest in terms of sectors, a lot of renewables. I think renewables is it's an ongoing structural play out there. And I also like what we call energy enablers or transition enablers, which means companies which previously have been polluting a lot and emitting a lot of carbon emissions, they are now changing the business model to think about more ESG-related kind of segments to the business. I'm excited about that because these are very, very long-term trends.
Yeah.
The other point I like a lot in the region itself is on the back of this reopening is consumer discretionary, right? The pent-up demand for consumer discretionary. Now, within consumer discretionary, you've got a lot of segments.
Yeah, of course.
Right? So obviously one of them is tourism. I'm super excited about tourism, especially in Southeast Asia. Why? Because a lot of the SME businesses and the corporates depend a lot on tourism.
Do you consider airlines and airports to be part of this sector?
Yeah, obviously. Right. But of course, airlines, as you know, is a different bag of thing because they have a lot of capex and all. But I think at some point they recover and the earnings recover, right? But I think, let's talk about tourism, right? Tourism in Southeast Asia is going to be a big boom, right? Thailand, for example, give you some numbers. Pre-COVID, 2019, the average tourist arrivals going to Thailand has averaged about 40 million. Okay? Last year, 10 million. Expectations this year, 20 million. Recovery, full recovery, maybe not 2024. But you can imagine the 10 million going to 20 million, going to 40 million. Yeah. I don't know whether you've been to Bangkok recently. I was there over Christmas.
I was there over when New Year, like 2 weeks ago. It was
and
bizarre.
Bizarre, right? So I
Not
can
just
te-
Bangkok. I was a bunch of other states.
Yeah. So I was there in September. Took me 5 to 10 minutes past immigration. I was there in November for our investor summit. It took me half an hour. I was there in December. It took me an hour. That is without Chinese tourist arrivals, which account for 40% of tourists going to Thailand previously. Can you imagine the world if they come back? So I'm saying, and that's just Thailand. What about the Balis of this world? What about Malaysia and so forth? Right? So I think this is going to be a huge pent-up demand. To a certain extent, markets have priced this in. You look at some of the stocks, for example, right? AOTs and all that kind of stuff, right?
Yeah.
They've done very, very well. But I'm a big believer that if you like this structural trend of tourism in Southeast Asia, it's a good opportunity to add on to portfolios.
Some tech companies that might leverage on tourism, I can say you can't, but Airbnb and many others. Do you feel that these kind of companies might leverage off the growth of or the potential upside on tourism and the reopening of China?
To a certain extent, because Airbnb, I think the bulk of it is in developed markets.
Yeah.
Right. So I think to a larger extent, most of these recovery plays in terms of reopening have been played out already. So I think where you want to be focused on from a global perspective on kind of consumer discretionary pent-up demand will be China, obviously, in Southeast Asia.
Okay. And the sectors that you might not be interested in or you might not want to touch right now?
I hate to use don't want to touch, but I would say that I'm very cautious of companies that have a business model that does not have earnings. And you know what I'm trying to allude to?
Yeah, I do.
Right. So in other words, there could be e-commerce companies, there could be digital companies, there could be a lot of other what we call funky, what we call non-profitable technology companies, right? I will avoid them with a 5-foot pole. Why? Because we are still not in an environment where people are going to give you a blank check just to spend money out there.
Not now, lah. I mean, previously maybe.
Yeah. So I think you have to be very, very discerning between profitable companies out there versus non-profitable companies out there. And it could be not just technology, it could be other segments of the whole spectrum of sectors as well.
I really need to pick your brain on this because a few months ago I was attending the Venture Capital and PE conference. They too are also looking for real growth and real income. Previously, these kind of sectors, these players, they don't normally need to look at this particular aspect of the game. But now they're also looking into a space where folks like you are also looking. So does that mean that the potential growth for companies to grow big into unicorns might see a problem because even growth-oriented investors might not necessarily look into their matrix of growing, say, users or market penetration, and not just plain cash profit and loss?
That's an excellent question, right? I do believe people will get more discerning because the cost of capital has risen, and when the cost of capital rises, right, your ROE expectations, your ROIC expectations, which basically how much more money can you make from the borrowing that you get.
Cost of capital for both equity and fixed income is rising.
Exactly. So I think people will be more discerning, but it doesn't necessarily mean that people will not continue to invest in this, right? Because at some point, in maybe the next 1 or 2 years, if the Fed starts to pivot towards lower rates, then this kind of blank check mentality may come back again. Who knows?
Yeah.
Right?
Yeah. So it's a fantastic answer. But no, honestly, right? But we'll go for a short break. When we come back, we'll discuss a little bit more with Patrick Chang, the CIO of Equities at Principal Southeast Asia. Thanks for staying on with us. I have with me in the studio Patrick Chang, the CIO of Equities ASEAN of Principal Southeast Asia. ASEAN, let's talk about that. The idea of sustainability, ESG, has taken a revolution around the world. In the ASEAN region, it's also taken a revolution. One thing that piqued my interest just now was the items that you spoke of. Companies that are in the transition mode that might want to be more sustainable, have lower carbon emission. How do you sieve through the fluff between lip service and the actuality of trying to be a little bit more green and, in the interest of the companies themselves, they want to be more sustainable? Do you feel that there's some companies that are genuine in this effort?
Absolutely, right? I think in Malaysia, so let's talk about Malaysia and clear it to home, right? There's two parts to the equation, right? This is a journey, It may sound cliche, but ESG is a journey, right? You can't get from A to Z overnight. Why? Because, for example, if you are a utility company and you've been using lots and lots of coal before, you can't just take out coal out of your books to fund your power plant, right? You need to find other enablers out there to basically shift that carbon mix, right? It will take some time. The next question you're going to ask yourself in that kind of equation is, how many assets can you invest in as fast as you can? There are not a lot of assets out there today. And so the valuations of most of these assets in renewables, power companies and so forth have gone to the roof, right? Because more money is chasing after very little goods. The point being is that when we invest, we want to make sure that, like you rightly said, they are not greenwashing. They're not just saying for the sake of saying. You know, I get honestly, very irritated when I see a corporate and they tell me I am going to more ESG because I'm buying more ESG assets. Now I ask them a very simple question. What are you doing for? The whole ESG journey is about doing better for the future. It's not just about because you want to whatever. The next question you're going to ask yourself is, you know, and most investors like ourselves are caught in between is, when you invest in this, there is going to be a gestation period in terms of profitability, right? So the question is, when you invest in this, how much timeline are you giving them to be fair to them, and how much are you willing to sit through them in that kind of journey? So in our view, at principle, our view is that we want to engage with these companies. We want to advise them about what you think you should be doing or not doing, not to tell them what to do, but tell them that this is our perspective of how your journey should be. And that's how we go back. So we send them questionnaires, we get them back and forth, and then after a while, they kind of get a picture that, look, principal is serious about this. And we're not just the only one, by the way, right?
Yeah,
the pension funds of Malaysia, of this world, are, you know, all the institutional investors are putting lots of pressure into all the corporates that invest in, including ourselves, to think about this journey and making sure that it is part of our process.
Do you feel that more regulation in terms of, say, tax breaks and other tax cuts could actually help fasten or hasten the pace of companies adopting better ESG practices?
It's a chicken and an egg, right? So if you throw more regulations into it, they may comply, but they could be greenwashing. At the same time, if you don't do it, people never do it. So, you know,
in the end, is it down to the consumers? The consumers must demand better practices.
So if you think along the lines of the European movement on ESG, right? From a Euro, so the ESG phenomenon has taken off big time over the last decade and a half in Europe, right? And then you move to America, and now it's in Asia, right? And so I've got a lovely chart that shows that in ESG engagements, Europe is one of the highest, and increasing Asia is also increasing. Point being is that you're right. The consumers in Europe started the movement to say, I do not want to buy a butter because it's produced from some person who doesn't have an ESG angle. That movement has now translated to how the corporates do it. But if you look at what happened in Europe, I'm not bashing the Europeans, right? But now all the fund management companies out there are all talking about ESG. But a report I just read late last year was saying that a lot of these companies are, from a governance point of view or ESG point of view, are actually overselling the ESG angle, right? So we have to be very careful. Now regulation is moving towards this to tell them, hey guys, stop saying it, do it properly. So I think what we can learn from this from an Asian context is that regulation is important, but you need to put a framework behind it. But ultimately, at the end of the day, is what does this A to Z journey look like, and how does this enable those companies to transition it, and how forgiving are we in terms of, like I said, the profitability angle and so forth. Those are considerations which, honestly speaking, I don't really have
it's fine.
But answer to it.
And of course, all this must be translated into how do you communicate it to the end consumer, I guess. Because that is the eventual buy-in that you need. As promised earlier, we need to talk a little bit more about Malaysia. What is your outlook on Malaysia, the government risk that we're talking about, whether or not there is a risk premium attached to this government risk and political risk, and are you optimistic about this new administration?
In a nutshell, I'm looking at Malaysia, not because I'm Malaysian and I want to say good things, right? But I think we are cautiously optimistic about Malaysia. Now, my analogy is very, very simple, right? I just did one event a couple of days ago and I said the same thing, I'm going to say it again. I think Malaysia has low-lying fruits that you can do that can propel itself to the next level. What do I mean by that? Number one, we have lived over the last, 8 years, 2 administrations of very high risk premiums, right? Almost similar to the kind of risk premiums that we compare against the Thailands of this world last time. You know, when they used to change government all the time, right? So I think if we were to move away from this and stop politicking and moving towards making sure that policies are geared towards the SMEs or the business people out there, attract more FDIs at some point. In case you guys don't realize, right? I just checked my analysts, right? The FDI as a percentage of GDP in end of 2021 was the highest in the region, approved, okay, in Malaysia versus the rest of the region. Vietnam used to be the number one.
I did not know this.
Yeah, so the point being is that we are open for business, but we need to tell the world that we are even more open for business because there is political stability.
So we need better storytellers. Folks like Tengku Zafrul at MITI would be a critical factor there.
I suppose so.
Okay, and of course, what would be some of the risks that you still think that is persistent and pertinent here to discuss when it comes to Malaysian growth story?
I think Malaysia basically, you know, if you attract more FDIs, you're going to attract more talent back. You know, I was just speaking to a Singaporean who was a Malaysian before, and I was having an argument with him in Johor 2 days ago, right? Okay. And I said, look, we were doing a panel speaking together.
We didn't break into a fist fight, no?
Yeah, no, not really. But we were just debating about how does Malaysia get back its stripes as a previous tiger, and it came out in one article in the media, right? And I said, it's not really rocket science, you know, right? We just have to fix our small little problems. Indonesia did it 8 years ago. Jokowi did it, right? And Indonesia, as it is, we speak, corruption's went down, more FDIs coming in, and so forth, right? Consumption's back, people are more confident, right? So we need to get that oomph back in the mindset of the people outside as well as people internally. What do we mean by that? The business people, the SMEs, the consumers, right? We need to beat ourselves less. Let's put it that way, right? Because if we continue to beat ourselves, we're going to be in this risk premium environment. And don't forget, Malaysia's risk premium is one of the highest in the region now. We are at 13 times PE. The way we read it, the market is not even factoring much earnings growth.
Yeah.
Right? Imagine the world if the risk premium drops, the PE re-rates. You know, it's going to be an interesting market.
But of course, we're looking at corporates in the region. I would argue that you know, corporates in Malaysia and Singapore would still be showing consistent earnings returns despite the COVID slowdown. Don't you think that these are the gems that we need to speak of when it comes to equities in this region?
Yeah, absolutely right. But if you take away from the typical FBMKL large cap, you know, companies out there, people don't realize this, right? But I was quite surprised myself, right? So I asked my analysts, I said, you know, what's the level of IPOs that we're getting in the first quarter? Huge amounts this quarter.
Yeah.
Okay? All of them are popping, all of them are making lots of money.
Yeah.
And then I look at the segments of the IPOs. They're all EMS companies, manufacturing companies.
Yeah.
Why are they coming to the market? Because they need more capital.
Yeah.
But they are also the net beneficiaries, as I said early on, to the whole supply chain that's moving outside of China into Southeast Asia.
Yeah.
So Malaysia, as you know, is very good in terms of manufacturing because we have very, very good FDI, you know, very, very good manufacturing base. You know, IP rights are very, very strong.
Stable.
The only problem we have is labor issues.
Yeah.
But if we fix the problem, more of these companies are going to pop out again. But these are small mid-cap companies. But I also do believe that, you know, that if we nurture this business to small to mid-cap to large cap, and that's something we need to think about, then one of these companies could be a unicorn in the future.
Yeah.
We are not selling Malaysia as a destination for investments. We're not selling Malaysia as a destination for capital markets. We need to do a better job.
Fantastic. Closing statements, Patrick?
Very simple. Everybody I know is very fearful of a global recession. Our view is that I think it's going to be a shallow one. I do think that you can still make money. I think if you are not sure, buy fixed income. If you want to take more risk, buy equities. And within equities, I'm optimistic for Asia. And I'm also hopeful that Malaysia will be the next tiger in the making.
Fantastic. Those are very optimistic statements. I'm very happy because not normally, it isn't normal for guests to come on my show and be a little bit more optimistic. I think yours is not just optimism, but of course backed with the kind of views and data that is required.
Yeah.
That was Patrick Chang, the CIO of Equities of ASEAN at Principal Southeast Asia. If you've missed any part of this interview, just head on to Astro AWANI and find out more there. You can also head off to Principal website. There's plenty of resources that you can find there. We'll leave you with this story of Principal Asset Management and their growth story behind this particular part of the world. Enjoy.
I never thought of myself as an author, but the other day, between all the meetings and conference calls, I heard someone say that lives are like stories. Wow, that stopped me. I mean, every day, don't we help people write the stories that become their lives? The beauty of it is that every story is different. Some are romances, some are adventures, some go viral, some are as ordinary as old socks. But here's the thing, every life story is real as it gets. I think the best stories are the ones that celebrate life's little victories, whether they're about getting ahead, giving back, or just growing old together. Truth is, we're all looking for happiness, however we define it. And no matter where we are or where we end up in life, our stories are all about getting there. When you look at it that way, the heart of our work is easy to grasp. Every day, around the world, we help people live their best lives. We prove one little step at a time that with the right financial partner, progress is possible. And as we help write their stories, we write great life stories of our own. We are Principal, and our new chapter is just beginning.